social media, contemporary marketers and entrepreneurs need help. One form of help resides in the effective integration of analytics with strategic marketing thought. Hello, everyone. I'm Gary Hunter. As well as where customer relationship management fits into it. So it's sort of going dark on the left-hand side, right? And it's sort of lighting up on the right-hand side. So CRM is really kind of focused on a lot of these different things that kind of drive acquisition and retention of customers. It's very much a concept that's related to customer lifetime value. So lifetime value is basically a way to kind of do calculations where you're trying to say how much is a particular customer worth. So this is an example of from like 1999, which is when a lot of this CLV stuff kind of got started. So it's been around for about 12 or 13 years. Are your companies using lifetime value calculations now? Okay. Okay, very good. So you can kind of take that data and you can say, okay, based on these data, the lifetime value of our existing customers, we might project that some segment of customers who are similar to these existing customers might be worth this amount of value down the road. So is that a segment that we want to target and go after, right? So sometimes you may come up with trades where you say the lifetime value of this customer is negative, right? This customer is actually costing us money. So about a couple of years ago, Sprint did this, right? Did you guys hear about the Sprint ordeal? This was in the papers. It kind of created a little bit of a PR issue, a little bit of a talk about 1,000 customers, right, that they had that they just dropped. They looked at these customers and said, these customers are costing us more money than we're making. How do customers cost you more money than you're making? If you're Sprint, what are those customers like? Okay, so they may be doing different things within your service that kind of affect your profitability or your margins in different ways. What other ways do they affect margins?
They like customer service.
They might really love customer service, right? They may be calling your customer service a lot, right? So you may have them kind of on the line quite a bit. If you have them on the line and they're complaining a lot, right? You know they're going to be very expensive customers, and you lose those in your Sprint. Do you feel bad about that? Who do you hope you lose it to? Your best competitor, right? You'd love to give those customers to your best competitor. So customer lifetime value and customer relationship management is often focused on when are the customers kind of adding value, when are they not adding value? How do you make decisions about which customers to keep? How do you make decisions about should I do this for this customer to kind of keep this customer happy or not? How can I use that data to kind of go out and target and profile new customers who are similar to kind of some of our most profitable customers. So those are all kind of uses of lifetime value analysis and kind of under the umbrella of this whole customer relationship management. So the whole idea is that if you think about customers individually, you can come up with different ways to kind of shape and tailor your marketing mix that's customized and serve those in different ways, right? So that's sort of the gist of it. What companies will do with this from a financial management standpoint is they'll take this data and they'll aggregate it up a lot of times, right? If you aggregate all the lifetime values of your customers to get one sum number, that's basically kind of the equity that you have in your installed base, right? So what's the value of your existing customer base? So that's a calculation. So how could you use numbers like that? Where would a number that says this is sort of what our customer base is worth, and we projected it out over their projected lifetimes? Okay, acquisition. So it'd be very useful for acquisitions, right? So if you're, either if you're the one selling or buying or whatever, it'd be nice to know what is the customer base worth, right? How else could you use some of this stuff?
Financing.
Financing. Okay, so how would you use it on financing?
Well, if you're trying to go public or if you're trying to get a loan, you would have something base your.
Okay, very good. So it's kind of showing what are your relationships worth over time, right? Other ways you could use it.
Can you use it for targeting?
I'm sorry?
For targeting?
You can use it. How would you use it for targeting?
You want to focus on those segments or customers with the highest value.
Okay. So that's sort of what Sean was talking about earlier, right? He was kind of saying, if you take it, you take the data, kind of use it for targeting, right? What other kind of aggregate decisions do you make with financial numbers within companies?
Well, you could do it for if you're coming up with, I guess, a new product or a new product line to see basically an extension of your current customers that would buy another customer. You could see how much your internal demand, I guess, would be.
Yeah, okay, so all these different iterations of like how you could look at different product lines and say, okay, this is sort of what this product line is worth. This is what that product line is worth. This is what this strategic business unit is worth. This is sort of what a new product might be worth, that we did some sets of calculations and say, well, would that add value to kind of our overall customer equity? So it's sort of another tool that you can use to kind of get at customer equity. Okay, so a lot of this data is kind of going in. There's all sorts of modeling that's going on that marketers are doing and that you're trying to do to try to analyze these different things. But in essence, the gist of it is that you're trying to move people through different relationships. You're trying to kind of acquire customers, and you're sort of trying to move them up to get a stronger commitment from those different customers over time, and to sort of understand how you might move them from kind of not knowing your company or not knowing your brands to some level where they're committed to your brand. So they become part of your install base, and ultimately you're trying to build install bases of different segments of customers that are profitable, right? So this is often, in lifetime analysis, we're often looking at different life cycles. Okay, so in the intro marketing class in the undergraduate program, some of you guys did those, right? We talk about life cycle analysis, right? So what is life cycle analysis then? Yeah, major events. Major events in a person's life, right? So you kind of grow up and you start and you're single. At some point you get married. At some point you have kids. This would be kind of your stereotypical lifestyle, right? Then ultimately your kids are kind of at different ages. You have younger kids, older kids. These different things are kind of predictors. Eventually they go out. You're an empty nester. All those things are sort of predictors of the types of needs that a household might have. So that's the customer life cycle. So that's very different from the life cycle that we're talking about here, right? So the life cycle that we're talking about here is more the life cycle of the relationship that the individual has with the firm, right? So we're saying, okay, this is the life cycle that we're interested in. We're thinking more about what's their relationship and how do we sort of grow that life cycle over time. So this is getting at how do you kind of increase value to different customers, right? You can increase their usage. So what are some ways that marketers increase usage? I don't know if I've given you guys some of these examples, I'm sure I have, but.
Rinse and repeat.
I'm sorry?
Rinse and repeat.
Rinse and repeat. So who used rinse and repeat? Shampoo manufacturer. So rinse and repeat is good because what?
You use more of their product.
Use more of their product, right? So use twice as much of their product. So these are usage ideas. So you can kind of change the usage, right? You can sell more of a product at higher margins, or you can basically kind of keep customers loyal for a longer period of time. All these are different things that you can do to try to change the value equation, to increase value to different customers, right? So this is the customer life cycle that I was talking about. So customers start with, they basically start as prospects. So we would do something to that target market where we're trying to generate some response. Some of them are going to respond. If they do sign up, they become kind of new customers. We want to try to figure out which of these are kind of high value, high potential, and which ones are low value. So how would we identify low value? As you come through the part-time program, how do we know you're a low value or respectively a low value? We're struggling. Yeah, you're struggling. You're not struggling with finance and accounting. You're struggling with marketing. Is marketing the easiest course you have? No, it's not. Okay. I tried to change that. So I appreciate that we're not the easiest course in the author, right? Okay, so why would I change it to where I don't want it to be the easiest course? And still say I'm loyal to the model.
Because you're building value within your customers.
How am I building value?
Because when you become more potential, better value, more likely, if we can get better jobs because of this, the way you teach the course, then.
Yeah, what are my underlying assumptions? You're getting pretty close to them, right? See, you thought I was just going to talk about you guys, right? I'm basically boiling me down to my bare bones.
Well, then if you make it harder, then we're going to learn more, so we're going to be able to apply more, so we can succeed more.
That's exactly it. So that's my whole model, right? So my whole model is that I think by kind of challenging you guys now, that you kind of become more successful later, and you kind of move into the high value, high potential customer base, and that you're more successful. Even if you don't give $1 back to the school, to be honest, I like seeing you guys succeed, right? Kirsten would probably hate me for that comment, but I do like to see you guys succeed. So what companies are often trying to figure out is they're trying to figure these sort of things out, right? Churn is kind of an issue. So people will talk about churn. So this is voluntary churn on the top side, and it's forced churn on the bottom side. So what does churn mean? Customer turnover, right? So these are kind of customers who are out here. If the top side's voluntary churn and the bottom side's forced churn.
Forced churn, you're basically
Yeah, okay, so how would that work in a part-time MBA program? Don't want them to graduate, right? See, no, I don't think any of you guys are in danger of this, but let's say somebody was doing really poorly, right? This is sort of the idea, right? How does graduating bad students or bad executives, right, or poorly performing executives, how does that affect our brand? Does it affect our brand? So I switch back to brand equity. How does it affect our brand?
It starts putting a negative connotation to the Case Western Weather MBA program.
Okay, and if we have negative connotations, these are the negative associations that are there that are based on these different alums that we have who are out there. That hurts our brand because people say, well, I don't want to go to Case because if I go to Case, I'm not going to learn anything about marketing, right? So this is sort of part of it, right? So what's the example of forced churn that I gave earlier from Sprint, right? Sprint's sort of a forced churn example. So voluntary churn is where most of the concern is. The forced churn isn't as big of a concern. The voluntary churn is a big deal because you have to do all these things that are called win-back strategies. So these win-back strategies are basically saying these were really valuable customers that we lost. This was someone who was maxing out in marketing and finance and operations, but they just said, I don't want to, I'm tired of this program, I'm leaving. I'm going to pick up my marbles, I'm going to go to a different school, I'm going to kind of succeed in that school, or I'm going to quit school altogether, right? And so that we lose that relationship with that individual. So the win-back strategies get a lot of attention because win-back is very expensive and very difficult to do, right? So once someone has kind of decided to kind of break the relationship with you as a customer, it's very difficult to kind of get them back into the fold. So there's a lot of attention that kind of goes into the avoiding voluntary churn on the customer relationship management side. Okay, so this first stage is essentially what we're calling acquisition, right? So when we're looking at the first stage where we're saying prospects are there, how do we acquire those? That's the acquisition stage. You can break this one down and call it an activation stage, where they're sort of active because then basically you've got data that you're collecting within the organization from that person who responded from some stimuli, right? So we're trying to say what's the response, and we get into the relationship management stage and how do we kind of manage customers through those different relationships. So if I look at these based on different data that I might collect across each one of these, let's say instead of being a school, I become a bank, right? That's kind of neat, right? This is the beauty of academics. 1 minute I'm selling shampoo and laundry detergent, the next minute I'm a bank, right? So now as a bank or a financial institution, I'm looking at some of the different campaign histories. What is it that we've done to try to get people to use our credit cards? I start thinking about those campaign histories, and I collect data on those. I collect data in terms of like demographics or purchase data. These are the kind of things that I have to do on the prospect side, right? Because until they've responded, I don't have any data that they've got. Once they respond, I start pulling credit reports. So I've got data on those individuals in terms of like what's their credit worthiness, what are some of the other things they've got on there that might be indicative of the types of products they like, or those types of things. I get any other type of self-reported information that I might have that comes from those different responses. Then over time, as they've been customers for some period of time, I can collect data that's on their payment histories, their campaign responses, their channel preferences, what works for me as an organization, their product purchase and usage. Those types of things are all data that I sort of get from customer over time. So all that data sort of goes into feeding a lot of these different models that I'm going to talk some about, right? So in determining customer value, then you're often looking at what's the cash flows, the inflows, right? And what are the outflows? So it's very much kind of a financial analysis standpoint. And then you're essentially just trying to say, how do I kind of break down some of those inflows and outflows? So these are different outflows. Outflows are things like acquisition costs. Development costs are really when we're saying, okay, how do we develop different customers or develop relationships, make our relationships stronger with existing customers. Retention costs are kind of the costs that I've got to kind of reduce attrition in order to try to reactivate different customers. So these are often called the ADR costs. So I have intrinsic value minus the ADR cost is basically what I'm looking at in terms of the customer lifetime value. So it's really the difference in those inflows, right, and the outflows. Okay, so if I look at focusing just on acquisition and activation first, right? So I'm just going to look at those two stages. I'm going to kind of say, okay, here's a customer acquisition analysis. So we started with a comment about customer acquisition earlier, right? So this is kind of getting at acquisition, but it's doing some things to say, okay, instead of just looking at acquisition for the entire customer base, I want to look at acquisition from these different channels. So I do some sort of promotion for my cards and stuff. One of the channels that I use is direct mail. One of the channels I use is in-store promotions, right? So these are things like as people check out of a particular retail outlet, I've got, you know, a card, a card application that's set there, right? So that's sort of in stores. I can do direct sales, which is where I'm contacting or sending mail directly to them, right? Or I'm actually got a person. So the sales side, this is a salesperson. So I've got a person who's actually kind of contacting different people. This might be telesales, or it might be mall intercepts, or those types of things, right? But this is kind of a salesperson who's actually person-to-person things. Then I might just do inserts, right? So these might be inserts that would be in magazines or something like that, right? So these are different channels that I might use: direct mail, in-store, direct sales, and inserts. And what I want to look at is I want to look at kind of the different number of prospects that are there, and I've got a response rate, right? So these response rates, how do I get those response rates? How do I get this 2%, 1.5%, 50%, 1%? Somebody buys something in the past, so I might use historical data to say what sorts of responses did we get out of these efforts in the past, right? So I might use those and say those are the response rates. What if I don't have any historical data? What if I'm an upstart company? How do I get these response rates? But in the end, if I haven't sold a product at all, these response rates, how do I get them? What's the worst case? How does Fermi get calculations, right? We did Fermi calculations earlier, right?
You buy market research.
I might buy market research, or what if I don't want to buy, what if I'm poor? I don't want to buy market research, I just wanted to sell my product. I just guess, right? So, you know, worst case, I'm going to come up with something that's some heuristic that I say, okay, I feel pretty comfortable. So that, so I can go pure art, right? I can just go kind of pure intuition and say, I think this is sort of what's going to happen. If I do the business for some period of time and I'm successful at doing it, what happens to my guesses? They get better because I start collecting data, I become more mature, I have a much better way. So if I'm putting 1.5% in and 2% in, do those look like kind of wild guesses or not? Those two don't, right? The 50% looks like a wild guess, doesn't it? But when you're kind of at, you know, at a decimal there, at a percentage, those look like they've got some historical data that's going into that. So they take that response rate and they're saying this many prospects, this is the number of responders that I would get, right? How many people are going to respond in each one of those channels? In terms of the percent of those who actually qualify for the card, how do I get that data? What do those look like? That has a decimal. It's like 1/3 and 2/3. It looks like a little bit of Kentucky windage, right? Doesn't it? So you got some stuff where you're saying, okay, this is the percent that I think will qualify, right? So I've got to stick something in there, right, to kind of go through my calculations, right? So I've got to think, well, how many of those are going to qualify through those different channels? So so basically this is saying that in-store and inserts, I'm getting lower qualifications through those, right? How would I add layers to this analysis? How would I kind of make it more? If I said in-store, well, 33%, I'm going to get 1/3. I'm doing in-store. I'm going to set this little stand on the end. It's got a credit card application as people check out. How do I, you know, if I'm a marketer and I don't want to take just one aggregate number for in-store, how do I get other data? Yes.
Depending on what stores they're coming from.
Okay, good.
High-end store has a much higher rate of qualification, whereas maybe a Walmart doesn't.
Okay, very good. So I might say I want to start segmenting my stores. And I want to say, okay, in-store Walmart, in-store Nordstrom, right? I'm going to get a better qualification out of Nordstrom than I get out of Walmart. So these are all layers that you can add. So you're basically just adding rows in that sense, right? So I might add rows to my analysis, right? And what you'll see later is that you can add columns to your analysis. So columns are, you know, as I get into the analysis, they're going to go more over time. So it's adding rows and columns is a lot of what you're doing when you're doing these different analyses, right? So we've got some number of qualified customers, and I'm going to convert some of those qualified customers or qualified prospects into customers, right? So this is kind of the number of people I convert. So I know this person has the money for the credit card. I know they're good for it. They're qualified, right? And then my conversion ratios are about 80%. So I've got an 80% conversion rate. That gives me the number of customers on the next set of calculations, right? If I say, okay, this is my effectiveness index, which I've given you at the bottom what that is, that's the ratio of customers to prospects, right? So it's just basically saying how effective are you within those different channels of converting prospects to customers, right? So you're much more effective in the direct sales channel. sales side shows us as being much more effective. This gives us then, I've got some cost data, right? So I get this cost data from outside that. That's not a calculation that's in the spreadsheet. But I've got some cost per prospect, right? If I know what my cost per prospect is, then I can kind of use that cost per prospect to get what would my total cost be to implement that different campaign. And then I can get kind of what's the cost per customer. Okay, so this is all about acquisition, right? This is basically giving me what is the cost to acquire a customer through these different channels, right? Are there assumptions in the analysis?
Yes.
Yeah, just pick them apart. We spend a lot of time kind of picking at different assumptions all throughout it, right? I've got some listed at the bottom, but there are other assumptions that aren't listed at the bottom, right? We're sort of picking out a lot of those different assumptions that are in there. We assume sort of aggregations and stuff that are in there. Aggregating is, a good way to kind of do it. So there's lots of stuff that's in there. But you can see, okay, so direct mail, if it costs us $140 to acquire a direct mail customer, how does that insight help us to make a decision about whether or not you want to do a direct mail campaign? What else do you need to know? How much they'll spend, right? So I need to know all this other stuff, right? I need to know these. I need to make all these different projections about if we do acquire that customer, how much is that customer going to spend over their relationship, right? The whole relationship management side. How much are they going to spend over their relationship with my firm? So I'm trying to say, okay, these are the revenues that that new customer would end up generating. So I've got different assumptions that I've got to go in with here. I've got to make assumptions now about what's the time frame or how far out am I going to project this. I make assumptions about discount rates, so you got to bring in all that stuff from finance that you wanted to bring in, right? That you were thinking, well, this is too simple at this point for marketing, so you got to bring in your finance skills. So you might say, okay, this is the discount rate. What if my discount rate is just ridiculous? 20% discount rate. What if that's a ridiculous discount rate? What's the simple fix? Change it to another one. That's the simple fix, right? I change it to another one in the analysis, right? If I'm not really sure, if I don't really feel comfortable about what discount rate I should use, then what would I do? I do a range, and that's called what? Sensitivity analysis, right? See, guys, you're getting all our business terms down. All the best with your efforts to master marketing and sales. I'm Gary Hunter, and I hope you have a great day.